Banks promise convenience, security, and easy access to your money. But behind the polished image lies a maze of hidden fees quietly draining your savings. From unnoticed maintenance charges to surprise overdraft penalties and sneaky ATM fees, these costs slowly chip away at your balance without you realizing it. Most people don't even notice the deductions until it's too late, because banks design these fees to blend into everyday transactions. We uncover the hidden bank charges eating your savings and show you how to protect your money from slipping away unnoticed. Today, we'll talk about hidden bank charges that eat your savings. So before we start, make sure to hit the like button and subscribe to my channel. 1. Monthly maintenance fees that punish low balances. One of the most common yet least understood charges is the monthly maintenance fee. Banks advertise free accounts, but many require a minimum balance or monthly deposit to keep them fee-free. When your balance dips below that threshold, even by a few dollars, the bank may charge a maintenance fee ranging from $5 to $25 per month. Over time, these small monthly deductions silently drain hundreds of dollars from customers, especially those who can least afford it. The irony is painful. The people who struggle to keep money in the account end up paying the most for simply owning one. 2. Overdraft fees, the most profitable mistake you can make. Overdraft fees are among the most notorious hidden charges in banking. When you swipe your card or pay a bill without enough money in your account, instead of declining the transaction, many banks approve it and charge an overdraft fee, often $30 to $40. What's more, multiple overdraft fees can stack up in a single day if several payments go through before you realize your balance is negative. Some banks even reorder your transactions from largest to smallest, increasing the likelihood of triggering more overdraft charges. This practice turns one small oversight into a cascade of expensive penalties. 3. Insufficient funds fees when your payment is never even completed. Insufficient funds, NSF fees are similar to overdraft fees, except the bank declines the transaction but still charges you for the attempt. That means you're charged for a payment the bank didn't even process. These fees typically cost the same as overdraft fees, but offer banks even greater profit because they carry no risk of temporarily covering the transaction. Many customers are unaware of NSF fees until they receive a monthly statement or see a reduced balance days later. 4. ATM fees, double deductions you don't expect. Using an out-of-network ATM usually triggers two separate charges, one from the ATM owner and another from your own bank. Each fee ranges from $2 to $6, turning a simple $40 withdrawal into a $50 expense. Some banks also charge international ATM fees, foreign conversion fees, or balance inquiry fees, simply for checking your remaining funds. Because ATM charges are small and often ignored, they accumulate quietly across the year, draining savings without notice. 5. Hidden transaction fees on debit and credit card purchases. Every time you use your card, especially for international transactions, online purchases, or subscriptions, you may be hit with hidden charges. Foreign transaction fees typically add 1% to 3% to the purchase amount, even if the purchase is made online from a foreign merchant. Additionally, some banks impose card processing charges for autopay setups, contactless payments, or certain merchant categories. While these fees appear tiny per transaction, their frequency amplifies their impact on long-term savings. 6. Paper statement fees and convenience penalties. Many banks quietly charge for paper statements, viewing them as premium services. These fees, anywhere from $1 to $5 per month, are marketed as environmental initiatives, encouraging customers to go digital. Yet in reality, they are another profit channel, a recurring charge applied simply for printing something banks already generate internally. Other similar convenience penalties include branch assistance fees, teller transaction fees, and fees for requesting older statements. 7. Excess withdrawal fees that punish you for using your own money. Savings accounts often come with restrictions on how many times you can withdraw or transfer money each month. Exceeding this limit triggers an excess withdrawal fee, usually around $5 to $15 per transaction. This rule existed originally to help banks maintain reserves, but today it is mostly a profit mechanism. Many customers unknowingly trigger these fees when moving money between accounts to pay bills or cover unexpected expenses. 8. Account dormancy fees when you don't use your account enough. If your account remains inactive for several months, the bank may charge dormancy or inactivity fees. Instead of simply closing unused accounts, banks milk them for profit, deducting monthly charges that slowly drain the remaining balance. Dormant account fees hurt individuals who maintain secondary accounts, emergency savings, or accounts for children that are not frequently accessed. 9. Wire transfer fees and hidden processing charges. Wire transfers, especially international ones, are notoriously expensive. Banks typically charge $15 to $45 for sending domestic wires and up to $60 for international transactions. What most customers don't know is that intermediary banks may take their own cut, resulting in additional deductions before the money reaches the recipient. Banks also hide fees under vague labels such as processing charges, lifting fees, or receiving fees, making the final cost much higher than advertised. 10. Foreign exchange markups hidden in currency conversion. When you travel abroad or send money overseas, banks often set their own exchange rates, embedding hidden markups that customers rarely notice. Instead of using the real mid-market rate, the rate you see on Google or Forex trackers, banks inflate the exchange spread, effectively selling you currency at a worse price. This hidden markup can cost far more than publicly advertised conversion fees and is one of the most discreet ways banks profit from international customers. 11. Minimum balance penalties and balance restoration charges. Many checking and savings accounts require minimum balances to avoid charges. If your balance falls below the requirement, banks may apply a penalty or maintenance fee. Some even impose balance restoration fees if your account remains too low for too long, charging you extra simply for not meeting their thresholds. These policies disproportionately impact low-income customers who struggle to maintain steady balances. 12. Return deposit fees on bounced checks you didn't write. If someone gives you a check that bounces, the bank may charge you a return deposit fee. This fee punishes the recipient rather than the issuer and can cost around $10 to $20. Customers often assume that receiving a bad check is the payer's responsibility, but banks take the opportunity to profit by penalizing both sides of the transaction. 13. Card replacement fees and emergency issue charges. Banks often charge for replacing lost or damaged debit cards. While some banks offer one free replacement, many charge $5 to $20 per card. If you need the card urgently, expedited shipping fees add another layer of cost. Considering that debit card production costs banks only cents, these charges are disproportionately large profit drivers. 14. Account closure fees that punish you for leaving. Some banks impose early account closure fees if you shut down an account too soon after opening it, usually within 60 to 180 days. This discourages customers from taking advantage of introductory offers or bonuses. These fees typically range from $25 to $50 and are rarely disclosed up front, appearing only in detailed terms and conditions. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.